Look at this. Price is grinding lower, and then this line underneath it just turns. Not a cross, not a candle pattern, the line itself bends and flips color. And from that exact bend, price rips higher into a clean target. Stick around, because by the end, I'm going to show you a second way to use this thing that almost nobody talks about for when the market isn't trending at all. Open TradingView, click Indicators, and search Nadaraya-Watson Trend. Click the one from QuantAlgo. Most traders have already seen a Nadaraya-Watson tool on TradingView. The problem is the popular version repaints, because the way it's calculated actually leans on bars that haven't happened yet, so it keeps adjusting its own recent history as new candles come in. This one only looks backward. Once it prints on a bar, it stays exactly where it printed. This line is the whole indicator. It's a smoothed read on price, and its color tells you the state. Yellow means the smoothed path is currently rising. Magenta means it's currently falling. That shaded fill between the line and live price shows how far price has stretched away from the smooth path. Tight fill, price is hugging the line. Wide fill, it's run a long way from it. These triangles are the actual signal. An upward triangle the moment the line stops falling and starts rising. A downward triangle the moment it stops rising and starts falling. That's a change in the trend itself, not just a price crossing a line. There are really only two settings in this whole panel worth knowing, and most people get the wrong one. You open the panel, you see a lookback window box, and you assume if you want a smoother line, you just crank that number up. Here's the trap. This dropdown lets you pick between a few different math models for how the line gets calculated. And for most of them, once you look back far enough, the older bars stop counting completely. So stretching that lookback window past a certain point does nothing at all for most of these, because those older bars already carry zero weight. The setting that actually controls smoothness is bandwidth, and the bandwidth multiplier sitting right next to it. Raise either one, and the line pulls in more of the recent history, so it smooths out. In plain terms, it gets slower to react, but steadier. Better suited to a daily chart you check twice a day. Lower them, and it tightens onto just the last few bars, reacting faster, but flipping on you more in a choppy session. If you don't want to hand tune any of that, the preset dropdown does it for you. Fast response for intraday, smooth trend for daily and weekly. And this is the classic versus hours moment. Watch the repainting version. As new candles form, it goes back and quietly redraws its own recent history. This one doesn't touch what's already printed. What you saw 2 bars ago is exactly what's still there now. This isn't a one-off either. This same shape shows up again and again across gold and the Nasdaq, and it's the exact flip we teased at the start. For this to actually mean something, the line itself needs to change color. Magenta to yellow for a bullish read, yellow to magenta for a bearish one, with price still sitting close to the line, not stretched way out in that shaded fill. A flip after a wide stretch is weaker, the line still has to travel back before it can even bend. So the real question every time is simple. Has the line actually turned, and is price still near it when it does? Quick thing before we get into the actual trades. Everything I just showed you only matters if you're at your desk the second that line bends. And be honest, most of these fire while you're asleep, at work, or you just looked away for 10 minutes. That's the real reason a good read doesn't turn into a good trade. So more traders are taking a tested strategy like this one and letting it run automatically on their own account or a prop firm challenge. So the setup still gets taken whether they're watching or not. And you get one-on-one guidance from ex-City of London traders instead of figuring it out alone.
You know, I've been in this space since 2016, and this is by far the best retail environment that I've seen in all of FX trade. I really mean that.
If that's you, there's a short video on the site that shows exactly how it works. The link's in the description. Right, back to the charts. Let's watch this play out for real. Zoom out first. On the daily, gold's been in a broader uptrend for weeks, so a pullback here is happening inside a trend that already wants to go up. That context matters. It's the difference between buying a dip and buying into nothing. Drop down to the 4-hour. Gold's been pulling back for a few sessions, the line is magenta, and price is riding right along it, respecting it the whole way down. Notice the shaded fill here too. It's been fairly tight through the pullback, which tells you price hasn't stretched far from the line even while it's been falling. That's actually useful information on its own. A tight fill during a pullback means the move down hasn't gotten emotional yet. Then, the line stalls, curls, and flips to yellow. That's the trigger. Entry comes on the close of that flip candle, or the next candle's open if you'd rather wait for one extra bar of confirmation before you're in. Stop goes just under the swing low that formed right before the flip, not further down under the whole pullback. That low is the actual point the setup is built on. If price takes it out, the read was wrong, and you want to be out clean, not still holding on hoping it turns. Target sits around 2 times that risk. And notice the shaded fill widening out as price runs away from the line. That's your visual read on how extended the move already is. Useful if you're thinking about trailing the stop instead of just taking the fixed target and walking away. Now the other direction, and it starts the same way. Zoom out first. On the daily, the Nasdaq's been climbing for a while. So this isn't a random top, it's a strong trend that's about to run out of road. Drop to the 4-hour. Price has been grinding along the top of the line in yellow, and then the line rolls over and flips to magenta. Same read as before, just flipped. The fill was tight while price hugged the line near the top, which is exactly what you'd expect right before a genuine reversal instead of just a brief dip. Entries on that flip, same as the long. Stop goes just above the swing high that printed right before it turned. That's the level this whole red depends on. So if price reclaims it, the setup's invalidated. Target again sits around 2 times that risk. And if price is still running when it gets there, the shaded fill is telling you the exact same thing it told you on the long. How far this move has already stretched, and whether you're still early enough to trail it, or whether you're chasing something that's already mostly played out. And you don't actually have to sit and stare at the chart waiting for either of these to happen. There's a built-in alert for exactly this, a bullish kernel reversal alert, and a bearish one. Set both, and TradingView pings you the moment the line actually flips on whatever markets and time frames you're watching. That way, you're not tied to the screen all day just to catch the one moment that actually matters. Here's the part almost nobody uses. There's a show residual bands option in the settings, and it's off by default. So if you're following along on your own chart right now, you won't see this unless you switch it on yourself. Turning it on builds an envelope around the trend line based on how far price has actually strayed from it recently. In a genuinely trending market, this is your overextension rid. Price tagging that outer band is a market that's already run hard, and that's usually not where you want to be chasing an entry. There's also a built-in alert for this exact moment, price crossing back inside the band after tagging it. Instead of only trading the color flip on the main line, some traders use that band cross as an earlier heads up that the stretch is running out of steam before the line itself has even turned. It's a rougher signal than the main flip, so treat it as a warning to pay attention, not a trade on its own. And that's also the honest limit of this tool. It's built to catch a change in trend. So in a market that's just chopping sideways with no real trend to catch, you'll see it flip back and forth without much to show for it. This isn't a tool that predicts a move before it happens. It confirms one that's already started, and it needs an actual trend out there to be worth trusting. One more thing worth knowing if you trade choppier conditions a lot: switch kernel type over to rational quadratic and lower the relative weighting number. That kernel keeps some weight on bars further back instead of dropping them off sharply, so the path holds its direction a bit longer through minor noise instead of flipping on every small pullback. It's not a fix for a dead, range-bound market. Nothing is, but it's a genuinely different tool for a market that's trending but messy, rather than one that's clean and trending like gold or the Nasdaq usually are. There's another one of these breakdowns waiting for you right now if you want to keep going. Stay disciplined, keep learning, and I'll see you in the next one.